tax benefits harm your financial well-being? Hello, I'm Sunita Abraham and welcome to one more edition of Why Not Mint Money. The budget is around the corner and this year, like every year, people are eagerly waiting to see what it has for taxpayers. In a year where people have been dealing with slowing income and high inflation, a boost from tax benefits seem very much on the cards. Today, I will take you through three situations where focusing on just tax benefits can actually hurt your financial well-being. The deduction from taxable income for investments made in products covered under Section 80C of the Income Tax Act is a popular tax benefit that puts money in the hands of the taxpayer by reducing the tax burden. But if you don't make the right selection, then this can do more harm than good. Most of the products included in the 80C basket, like the National Savings Certificate, bank and post office fixed deposits of 5-year tenure, Employee Provident Fund, and the Public Provident Fund, among others, are fixed income or debt-oriented products. And when you add the sweetener of guaranteed returns, they become the automatic choice for investors. But do you need so much exposure to debt products in your portfolio if you're saving for long-term goals? Consider the situation of a person who contributes to the Employee Provident Fund and there is an equivalent contribution by the employer too. For a person saving for goals well in the future, where the focus should be on growth investments like equity, that is quite a significant exposure to fixed income investments already in the portfolio. By selecting more debt products for the tax benefits they provide, you are condemning your savings to earning a lower return than what it actually could by being invested in, say, equity. And this will affect how well you're able to meet your needs in the future. There are a few equity-oriented investments too in the 80C basket, like the equity-linked savings schemes that you can consider if that is the asset class that your allocation demands. Here is another point for you to consider when utilizing the benefit of tax deduction available under Section 80C. Your tax flow is lower and that is money saved. Instead of spending that money, if you chose to invest it, you can actually give a big boost to your portfolio and the goals you are investing for. The layer of tax benefits can lead you to wrong product choices too within an asset class. Take investment in gold, for instance. The sovereign gold bond scheme has become the product of choice for investors given the additional interest income and, more importantly, the exemption from long-term capital gains if the bonds are held to maturity. This works for investors who have a holding period of at least 8 years, and this is the tenor of the bonds. But if you are investing in gold to meet a need that is likely to come sooner than 8 years, say to give gold on the occasion like marriage, then you may find it difficult to meet it if you're not able to sell the bonds in the secondary market at the then prevalent price of gold. And you will anyway have to bear the capital gains tax when you sell the bonds in the market before maturity. Instead, a product like the gold ETF that allows you to invest periodically and redeem whenever you want the funds may be a more suitable product for accumulating a corpus. Similarly, choosing a bond for investment just because it gives tax-free interest may be a losing proposition if you don't need the income stream and unless you are able to reinvest the interest immediately. Else, you may just end up spending the interest income and your corpus will be poorer for that. The asset allocation that you follow and the investments that you choose must be a function of your goals, time horizon, and risk profile. The tax benefits should just be one more feature that you evaluate. In this tax season then, select wisely so that you build a portfolio that is aligned to your needs. Thank you.